Welcome to our weekly Forex Futures Forecast. My name is Jay Norris. I teach trading at Trading University. First market we're going to take a look at today will be the Australian US dollar. Aussie USD, you see that green line right there? That's potential support. That's all it is a two-third retracement of this large secondary pattern that you're looking at. You always want to focus on those levels. So many times it doesn't even matter the fundamentals out there. It doesn't even matter what the fundamentals are around the corner. So many times we just see markets pause at those levels here. You couldn't get the second close below it, so the market's giving us a reaction here. Short covering rally higher. It's definitely an area on the chart where you want to take an interest in that market. I'll tell you, we're going to come back to this when we cover another market in the commodities too. So yeah, we definitely like Aussie dollar at these levels. I know I was kind of bad-mouthing it up here the last couple of reports. It's just too much risk for us there. Really, what we do is we identify those areas on the chart where you're going to get a low risk, high reward setup. We're pretty good at that. Next market we'll take a look at will be the dollar Swiss. There's the Swissy. You know, we've been talking about this for a long time, that breakout in dollar Swiss, and there you have it. We always pan all the way out to the long-term chart so you can get scale on this move. There it is. That's a pretty big breakout right there. We put a trend line on there. A lot of room on the upside. We think that's a great longer-term investment, and we'll get into the why of that too when we cover these other markets. Shorter term, here's our Swissy intraday. It could get a little bit choppy there. You can see some good support levels still below the market. We'd definitely be interested in swing trades at those levels. Well, I'd love to see 99.5 again come all the way back to essentially the breakout just above 100, just above par, maybe a little dip below there, run some stops, and that would definitely be an area of interest as a swing trader, a little bit longer term trader. You could continue to see some pretty good volatility in here. Keep in mind that we feel this market has broken out, so long term, it's one where you want to get in on the long side. There's dollar Swissy, and you can see the breakout from that wide sideways range. It's been in much of the year. Next market, dollar index. Dollar index daily chart. There you can see the big breakout too. Pop out to a weekly chart, and you can see that this guy made a higher high there. Definitely a market where you'd be interested in buying dips. We think there's some more room to go on the upside. Couple reasons for that. You had great reasons in place prior to the U.S. election. You had the U.S. economy was a little bit further along as far as growth, the growth cycle. We see initially the president-elect's policies being dollar bullish. The biggest change that we think we'll see, we'll wait, we'll talk about that when we cover the euro. Want to keep moving along euro, the next market. Yeah, the biggest change we feel that you'll see in U.S. policy. Here's a weekly euro chart, and you can see the sharp weakness you've seen since the election. Let me scroll back down to a daily chart. In the past, there it is, a whole lot of room on the downside there. Most recently, in the past, U.S. Treasury policy, U.S. Federal Reserve policy was coordinated with the European Central Bank, with the different central banks around the globe, and one of their goals there was to keep the euro propped up, to keep the euro strong. Let me pop out to a weekly chart. I'll give you a great example of this. We thought they did a masterful job of keeping the euro propped up in here. Now, what does that do? That ensures that as people are paying back their loans to the European banks in euro dollars, right, that money's not coming back devalued, right? You can imagine if you loaned somebody euros up here and they're paying you back now down here, then you're getting a devalued currency. Not good for an already shaky banking system. So we thought the ECB did a great job, and believe me, they couldn't have done it without the help of the Fed in here, without the help of the U.S. Treasury Department also. And we think they've been trying their best in here to keep that guy propped up, much to the chagrin of speculators who wanted to see a lower euro, who understood that you had bearish fundamentals, but the central banks were coordinating, trying to keep that guy propped up. It also proved good opportunities for your ECB banks, European area banks, to be able to hedge off that risk and sell the euro at higher levels. You really can't do that when it's streaming lower as it is right now. So big prop pulled out from underneath that, because we don't think that the Treasury Department under the president-elect will be so friendly, will be as understanding of a coordinated global policy as the previous administration, the previous Treasury Department has been. We'll see. But based on everything he said leading up to that election, we think it's kind of a gimme that you're no longer going to see that central bank, that Treasury Department coordination that was so important in keeping the euro propped up like that. Again, so that ECB banks could be paid back at dollar on or euro on the euro, I should say, not at a devalued level, such as you're going to see right now. So the lower the euro goes, the more problems that's going to cause European banks. And you'll see that spilling over too into the different currencies and different stock indices too around the globe. So that's something to watch for right now. Next market we're gonna talk about. Let me show you the gold market. I haven't covered gold in a while. Remember, I said I'll come back to this. I said I made reference to this when I was looking at the Aussie dollar. And here's what I mean. The Aussie dollar, some people call it a commodity currency. Well, it's not really a commodity currency because the biggest producer of commodities is the United States. But it does have a strong correlation to gold and silver are correlated to the Aussie dollar. So we're definitely taking a look at this level in the gold. And, 2/3 is a very critical level for sure. Let me pull up a slide to make this point. Now, this is straight out of Dow theory. A market can retrace up to 2/3 of itself and still maintain its primary pattern. Okay? Here's gold. That's a 2/3 retracement coming up in the gold market. Now, what's the primary pattern in gold? The primary pattern is higher in gold, actually. Time has shifted that primary pattern higher. A great rule of thumb for gauging a primary pattern in a market is look back at 12 months worth of data. You can't hide a bull market or a bear market in 12 months of data. You have a bull market. You have an uptrend here overall. So as long as it's holding that 2/3, the primary pattern in gold is currently higher. So you're coming up on support of a primary pattern. Regardless of what's around the corner, regardless of what's going on right now, that tends to be a pretty low risk time to focus on trading a market from that level. So definitely gold one to watch here, particularly when you tie that back into what I was saying as far as the Treasury no longer being coordinated necessarily with its own U.S. Fed and the ECB. So that's going to be something to watch. And you're going to have a whole new cast of characters in Washington, in the Treasury Department specifically, and I guarantee you that the markets are going to test those people. It's inevitable. Every administration gets those early tests where the market wants to find out who's the boss. So you tie that in with what's happening now in the price of gold. It's going down right now. That's great for us. Basically, you're running out longs of that market, but you'll get to a point the selling has exhausted itself, and we'll find what we see is potentially a cheap market, particularly what could happen in the future. We're not here to prognosticate what's going to happen in the future. We just know that that's a pretty interesting level on the chart, low risk, high reward level to potentially go long that market. So let's definitely all keep an eye on that. Here's the silver market. Silver, by the way, leading indicator market for us, has been for decades. There's silver. There's that 2/3 level in silver. Look, you already tested it. You tested 2/3 there. You had a little bit of a green candle last Friday. So we think silver, very definitely another market to watch. Very low risk level on the chart for us. You couple that in with what's going on in Washington, where you're seeing the tremendous change there. And markets don't like change, by the way. That tends to create uncertainty. And believe me, there's no better market to hedge uncertainty, to hedge those fears in long gold, long silver. So silver and gold, those are markets that we'll include in our repertoire. We'll continue to keep an eye on them. For us, we'll definitely be focusing on those in our live classes, too, our live trading classes. And the last market we'll take a look at will be dollar yen. Boy, dollar yen's had a heck of a run here. Big run up. Boy, look at that. You've almost retraced 2/3 of that entire bear market. No surprise there. We liked it. It went up so fast, though. It really not many opportunities from a swing trader. Let me go down to a 4-hour chart. And boy, this has been a great market to day trade for us. Here you can see these very short-term day trade levels. That's just a buy zone that we place on the chart. You pick up those short-term resistance, in this case short-term support levels, and that's where we've been focusing on that. So having a lot of fun. It's really been the gift that keeps giving dollar yen from a day trader's perspective. But the volatility is rising now. You're getting up there kind of in the nosebleed seats for us. So we still like it. We'll still continue to day trade it from those zones as long as it's making higher lows and higher highs. Right? As long as it's rewarding us, we're going to focus on that. But kind of interesting that now, looking at your commodities and your Australian dollar, the gold, silver, to us, we see those a little bit more interesting now than we saw dollar yen. Love dollar yen on the breakout. Loved it buying these short-term dips along the way, but you pan out to a daily chart. Getting a little bit riskier now. We just think from a trader's perspective, potentially easier pockets to pick, i.e. keep an eye on those metals, continue to sell rallies in the euro. My name is Jay Norris. I teach the art of trading at Trading University. Thank you so much, and we'll see you next time.